QYLD is the Global X Nasdaq-100 covered call ETF. It launched in December of the year 2015 and is one of the largest and most widely held covered call ETFs. It aims to give investors high monthly income by owning the Nasdaq-100 index and selling call options on that same index. How QYLD works. QYLD buys all the stocks in the Nasdaq-100, which includes big names like Apple, Microsoft, Alphabet, Amazon, Nvidia, and others. Then, each month, QYLD sells a call option on the index with a strike price near the current level. That means it receives a premium, cash payment, for selling someone else the right to buy the index at that price. If the index stays below the strike price, the option expires and QYLD keeps the premium. QYLD distributes that cash every month. Income performance. QYLD typically yields around 11 to 12% annually. That means, on a $10,000 investment, you might receive approximately $1,100 to $1,200 per year in monthly payments. However, this yield can fluctuate depending on market conditions and option premium levels. Growth trade-off. Because QYLD sells upside potential each month, it gives up some of the gains when the Nasdaq-100 rallies. For example, in years when Nasdaq tops large milestones, QYLD tends to severely lag because of the sold calls. Investors accept this trade-off to get predictable income, volatility, and risk. QYLD offers lower monthly volatility compared to holding the Nasdaq without the covered call strategy. This can create a smoother ride, but the fund does not protect against sharp drops. A correction in the tech sector will affect QYLD like any other equity fund. It will decline, though perhaps less quickly. Size and costs. QYLD is very large, with over $16 billion in assets under management, making it highly liquid with tight bid-ask spreads. Its expense ratio is around 75 basis points, which is 0.75%. That is higher than a passive Nasdaq ETF, but typical for a covered call strategy. Tax implications. Monthly distributions from QYLD are primarily treated as ordinary income, sometimes with return of capital components. That means taxable account investors may owe higher taxes, and returns may be more tax efficient if the ETF is held in a retirement account, like a traditional or Roth IRA ideal fit. QYLD is best for investors focused on monthly income, such as retirees or income planners, who want exposure to large tech stocks and are okay with reduced growth on big up years. My meter rating. Income, 5 out of 5. The monthly cash is strong and reliable. Growth, 2 out of 5. Growth is limited due to the covered call drag. Volatility reduction, 3 out of 5. Offers smoother movement but still exposed to declines. Tax efficiency, 3 out of 5. Mostly ordinary income, so better in tax-advantaged accounts. Simplicity, 5 out of 5. Very easy to own like any ETF, with straightforward monthly payouts. Total score, 3.6 out of 5. Is QYLD right for you? QYLD makes sense if you want dependable monthly income and can accept lower returns during rising markets. If you want full growth Nasdaq from an ETF like QQQ or VGT may be better. For balanced income seekers, QYLD is a top choice. If you have any videos you'd like me to cover, say it in the comments below and I will break it down in plain English.